Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Monday. It's the 14th of November. Don't ask me where the year has gone. I have no answers for you. But I do have some answers in regards to the stock market. A lot of answers from a lot of questions that I received this weekend. So let's get into it. And we've got a lot to talk about. And folks, you may not like what I have to say today. But again, I want to be real with you. I want to be honest with you, and I want to show you exactly what I'm seeing in the market. So we're opening up a little bit lower today, and the question now remains, okay, we had the CPI, we had some positive news, earnings were not as bad, but what's on the table this week? Remember, the market has a very, very short-term memory, and it can go from bearish to bullish like that, and it can go from bearish to bullish and bullish to bearish just like that. Very short-term memory. So we're opening up a little bit down, and the big question is, what are the major catalysts this week? Well, you've got some earnings. You've got some retail earnings, big ones. Home Depot and Cisco. You've got Walmart. That's Tuesday. So Tuesday, you've got Home Depot and Walmart. Today, you've got Tower Semiconductor, Tyson Foods. Nothing really huge, but the retail, tomorrow's a big day for retail. Here's what's baked into the market. As you can see here, Home Depot is looking for a 4.8% year over year EPS. Not too bad. And Walmart is looking for a negative 9%. I have a feeling that both of these are going to do well in terms of the revenue and the year-over-year guidance. I think they're going to meet estimates. What I'm really concerned about is what they're going to say next year. And then we've got Cisco, the big cybersecurity giant Cisco. That's happening on Wednesday, and they're looking for a little bit of a bump, 2.4% year-over-year, and a little bump on revenue. What's interesting is that all of these stocks are not expecting a huge bump on revenue, which is something that we did see a little bit last quarter. So the earnings are not as broad-based right now. They're getting into very specific areas like retail, and those typically are the last ones before the small caps report. So it'll be very interesting to see how that does. Now, another major factor that I want to bring to your attention, and that's the put-to-call ratio. As you could see here, the put-to-call ratio right now is at 75. Now, the put-to-call ratio, 75 isn't all that low. Anything below 70 is low, but it's worth talking about right now because we haven't had the put-to-call ratio this low since last year. My goodness. So this is very, very important and very vital because it's actually telling us that for once the stock market is not oversold, that it's actually a little bit overbought right now. Oh yeah, it's like that. Now, as I show you this, I want to talk about a couple of things. So let me just show you something. If you look at momentum levels, and it's very important to look at momentum levels. The 50-day, I mean, this is really looking very rosy. But when you look at this, 53, 63, 48, energy 100, but for the most part, these sectors here, the 200-day, there's still a lot of red here, and there's still a lot of purple here. It's not all green. And remember what I said, this is what controls. This is like the dog that just saw a pretty puppy and it just gets ready to run. And this is the owner with the brain in their head. So this is emotion, and this is logic right here. So I want to show you something interesting if you look at that on some sectors. Like, for example, if you look at consumer discretionary, this is the S&P consumer discretionary sector. Look at how overbought it is. Folks, it hasn't been this overbought since the recovery from COVID and since 2016. I just want to show you this so you could see it with yourself. This is the consumer discretionary sector in the S&P 500. It doesn't have a lot of upside to go. Now, look at the NASDAQ 100, the entire NASDAQ 100. It's got a little bit to go. I mean, if you want to talk about breaking highs, but we're getting up there. I mean, let's just break this down a little bit. Look at where we're at right now. We're getting a little toppy. So in my opinion, I mean, just you don't have to go far, but look at some of these. Look at industrial. Look at information technology. Look at that. That's not low. So when you take into account the fact that these stocks that are now way overbought, and when you take that into account with the put-to-call ratio, which is down here, which says the market is not oversold, that leads me to danger zone. And that's one of the reasons why I believe the Dow Jones right now, which doesn't really have a major catalyst, is in a very, very precarious position because we've seen the upside, right? We've seen the rallies, right? And look how overextended this thing is. And it's diverging. So I'm very, very, very nervous about the broad market. I mean, holding positions for 3, 4, 5 days is okay, but I think this is a little overdone, and I think it's a sucker's play right now. And I think the Dow's going to come down, and I think the NASDAQ 100, the stocks above the 50-day moving average, the consumer discretionary stocks, which are at 90th percentile, they just don't have anywhere else to go. So in my opinion, before I go deeper into this analysis, I think the broad market, even the NASDAQ, which I'll talk about more in a second, is overbought. I mean, it's not reaching the 200-day line, but it's diverging very, very strongly. I don't think it's got that much more to go. Also, if you look at the bond market, notice the bond market isn't going higher anymore. It huffed, it puffed, it went from 92 to 97, but it doesn't look like it's ready to go much higher at this point. That means there's a lot more pressure on the economy. It doesn't mean things are getting better. It means there's a lot of pressure. So that's a big, big red flag. And again, keep your eye on this. Like, for example, only 53% of stocks are trading above the 200-day moving average on the index, S&P. On the Dow, you've got 42%. 42%. And I mean, this is not an overbought market in the long term. Look at this. But in the short term, it's a little overdone. It's a little bit overdone. So I believe we're going to see the stocks revert back to their mean, which is not looking all that great. And I believe that a lot of these stocks, a lot of these 50-day moving averages are going to start looking like this, like what we're seeing right here. Because communication services, real estate didn't really move much. Utilities, I think, are still overdone. And as long as energy prices continue moving, we'll see more upside. I think they're actually at a value right now. But I would be very, very cautious, especially when you're seeing 19% of real estate stocks trading above the 200-day moving average and 71 trading above the 200-day moving average. I mean, look at this. This doesn't look like it's got much more to go. So in my opinion, there's not that many catalysts left. That CPI was a major catalyst, but I'm not seeing major catalysts this week to take us higher. And I think we're going to be reminded this week that economy is still in the crapper, excuse my French. The PPI is coming out tomorrow. You've got retail sales coming out tomorrow, industrial production coming out tomorrow. These reports are not expecting to be great. It's not coming out tomorrow. It's coming out on Wednesday. But the report flow starting to come out tomorrow with the PPI, then Wednesday retail sales, industrial production. You've got jobless claims. And I'm not expecting really rosy numbers from any of these. So I would be very, very cautious. I would be watching the bond market. I would right now be watching these indices and the momentum levels, and I believe that this is going to start looking a lot like this over the next couple of weeks, which is why I still have a lot of short exposure. Also, I'm not happy with the put-to-call ratio being where it is in terms of the bulls. 75, 72, that's really, really low, which means the market is getting overbought, as I've been telling you. So it's very, very, very important that we keep an eye on things this month, especially the major indices and volatility, which I'll talk about next. Let's talk a little bit about global economy. Stocks are down right now after 3 U.S. benchmarks closed higher on Friday, demonstrating their strongest weekly advances in 5 months. That should right there give you a clue that things are not all that great. The big sectors that rallied were energy, consumer services, and technology, which is kind of odd, but CPI was very, very, I think it was very distorting. I think it gave people false hope. Federal Reserve Governor Christopher Waller warned that while central banks is considering smaller rate hikes, it has no plans of softening its stance on inflation, given that the reading was still well above 2%. It was well above 2%. So there's nothing, I don't know what people are getting so excited about. After last week's inflation data, U.S. futures have priced in 80% of a 50 basis point rate hike and a 19% of a 75. And I think if the data keeps getting worse this week, you're going to see this number increase, the 75, and this number decrease again. And if the data keeps getting better, you're going to see this number increase and this number decrease. It's all right now between 0.50 and 0.75, and it's the ratio. It's ratio. Remember I said after CPI, it's going to go one side. It was like 45, 55. Now it's 80 versus 19. That's what I was talking about. This week, we've got a lot of news, and a lot of it may not be good. We've got the PPI. We got the exports. We got retail sales data, which I'm not expecting to be great. We got building permits, housing starts, and existing home sales. Today is a reprieve, which we desperately need. Europe, things are not looking good. We may be going into a recession in Europe, which is going to drag down the U.S. economy. It's got a lot of work to do before it patches up with the Fed's tightening. Remember, they were very laissez-faire for a while there with their COVID policy, and they had negative interest rates. I don't know what kind of crap they're pulling. Inflation in the Eurozone is rising. Remember, the world is one. It's going to impact USA markets. Eurozone CPI data due largely this week is expected to stand, at 10.7% up in October compared to 9.9% in September. Morgan Stanley said that the British and Eurozone economy might fall into recession next year, estimating the global economy grew by just 2.2% next year. So, folks, we're not out of this just yet. China's Shanghai erased nearly all the gains, closed lower, as the country grapples with its worst outbreak in 6 months. Ouch. And remember, I'm hearing some news from T-Buzz and his crew that in New York, things are getting pretty bad with COVID too. I'll have to check that. The news mainly offsets optimism over new stimulus measures for the country's hard-hitting property sector. The property stocks climbed on prospects of more government aid, and the Japanese market didn't do well at all. They were trampled down by transports, railroad, buses, and shipping stocks. Again, we've got three major reports on the docket that we need to know about. Tomorrow, Home Depot and Walmart. It's going to be a big day for retailers. Then you've got Wednesday, Cisco, and today you've got Tyson Foods and Lee Auto, which is an interesting company, and Weber, the barbecue place. It'll be very interesting. Tower Semiconductor. Again, nothing crazy today, but tomorrow and Wednesday, we've got some big stuff. Again, put the call ratio sending us very clear signs that this market is not oversold. The real estate sector, all the other sectors are showing me signs that we're topping out right here. They're a little too high right now, and I think the market needs to cool off. Now, it doesn't mean we can't have some interesting swing trades in between to make money to the upside, but I think the overall trend is going to go lower. Now, folks, I got something important for you. To succeed in this market, you got to wait for the right opportunity to strike. It really just comes down to that. Inflation and Fed throwing stocks into disarray every month, it seems. High probability entry signals are becoming harder and harder to isolate. That's why I'm going live today to share five bear market entry signals that every trader should be looking for right now. In this crazy market, we've had a real-time signal trade record of 81.48% on all closed trades, and the one open trade we have is at a winner right now. You really should check it out. It's very cool, and it doesn't matter. It doesn't care if the market's bullish or bearish. It holds trades on average of 5 days. That's why I'm going live today, and I'm going to share these 5 market entry signals. Some are bull, some are bear. You're going to love them. You cannot afford to miss out because one of them gave us a back test of 93% accuracy in a 10-year test. And I'm going to share all of it with you, every last detail, the name of these 5 patterns, how to trade these 5 patterns, the statistics on the S&P of these 5 patterns. You don't want to miss out. Come hang out with me at 1 p.m. Eastern Time. It's happening today. Follow the link below. Do not miss out. And I'll talk to you guys soon. Bye, guys. Have a great day.